Well, despite the rally so far this week, our next guest says it's going to be a bumpy ride through year end. Let's bring in Morgan Stanley's chief U.S. equity strategist, Mike Wilson. Mike, I'm going to just give you sort of an open question to kick this off. How do you think we should read what's happened here the last couple of days? It feels like all systems go, but should we be worried that there's some bumpy road to go still?
I think absolutely. I mean, I think that this month is going to be all about positioning, both on the upside and the downside. And one of the things we talked about this week is, I think more than ever, it's December. I think a lot of folks really had a tough November, got whipped around, and, you need to fade moves, both up and down. So we just had two really good days. I'm fading it. I think last week at the end of the week, we, got clocked into Thursday and Friday. You wanted to kind of pick up some stuff. But these are trades. And, I don't think we're out of the woods at all on some of the concerns that are out there. I would highlight three things that we're focused on the most. The number one thing is tapering. OK, we've been talking about this since September. Yes, the market knows this is coming. The Fed has been very explicit about it. But when you're going to take $1.5 trillion on an annual rate out of their purchases and take it to zero in 4 months, it's going to leave a mark. OK, and that's valuations coming down. So we want to be very focused on valuation. You cannot overpay for assets right now. And the Russell, I know Guy was just talking about a minute ago, like I'm a fader of the Russell for sure, because the second concern we have is earnings stability and the ability to operate in what is a very difficult environment. And, this is a low quality index, right? It's a bunch of companies that are probably struggling to operate in an environment that's quite difficult. So, valuation, earnings stability, those are the two key factors that we're really focused on right now. And then this volatility is definitely going to be with us probably through the end because of positioning and just the need to perform both up and down.
Mike, you've been pretty, I think, consistent and steadfast in your caution here, and you have been for a couple months. And largely it's right, especially as we set up for 22, and you're talking about higher rates and you're talking about EPS downward revisions. You like value, you like healthcare, you like banks. One of the problems for value, quote unquote, has been that value has been a major underperformer. Is this the setup that finally sees it? Because again, look, banks have had a nice run. You could also make an argument that they've been a beneficiary of being the best kind of value on the block, where deep value has been kind of a death trap. Yeah.
No, we don't like value per se, like the growth versus value continuum. I think people obsess over that too much. We have at times too, and I don't think that's really the call that we're making. We're making a call really on valuation, and what that means is growth stocks can do just fine. You just can't pay egregious multiples. We've been very consistent about that really since April. That we like reasonably priced growth stocks, and then valuation matters in things like healthcare. We like because it's probably the cheapest it's ever been relative to the market, and they actually have pretty good growth outlook. Banks will be difficult if the market decides rates are going to go back down. That that's going to be a bond rally. But we think they're cheap enough that they can weather that storm, and the earnings power there looks pretty attractive into next year.
Hey, Mike, it's Karen. Thanks for being on. I just want to go back to something you said about the Fed tapering. So we all agree that they have, telegraphed to the market very clearly. But are you saying that you think the magnitude of the taper is such that even if everybody knows it, there's still going to be a negative reaction to it?
I think so. I think definitely for certain assets. I mean, I think we all can agree that there's been a little froth and speculation in these markets this year, and a big part of that has been the monetary accommodation, not just from the Fed but from all central banks. And I think taking the air out of that balloon is going and doing it quickly, I think is going to have a negative impact on some of those parts of the market. Now, we saw that the last couple of weeks. I think people were making the argument this week that damage was done. And we would disagree with that. We still see pockets of excess that will be hurt from the air coming out faster than what people were thinking just a month or two ago.
So, Mike, even if we're not exactly sure what's going to happen, I guess we never really are, and you see there could be three possible outcomes, what's the best way as an investor to set yourself up for 2022?
Well, look, I mean, there is a bull story here that, probably at some point next year, and we're on board with this, the global economy hasn't even really begun to recover yet, right? So the U.S. has really pulled forward a lot of demand. It's been the place to be for sure. But the global economy, is still kind of wobbling. And our expectation is that, the virus will work its way through this next wave. We'll get vaccination programs up and running, further around the world. and we'll have a global synchronous recovery at some point in the second half of next year. I just don't think we're there yet. I think we got to get through the initial stages of this tapering, which, by the way, the fact that the Fed is tapering faster is a good thing. It means that the recovery is progressing. We just priced a lot of that in the U.S. Outside the U.S., I think there's more to come, and that can benefit multinational companies. I just think right now you want to stay closer to home in terms of making sure you know these companies are going to earn in any kind of an environment, and you're not overpaying for it, which is, I think, the key variable for the next 3 or 4 months.
Got it. Mike Wilson, thank you very much for joining us tonight, talking through it all. Tim, what's your take now that we've sort of fleshed out this conversation a little bit more with Mike? What do you think of his points?
Well, Mike's right to be cautious about more Fed, and I believe we're certainly going to have to deal with more Fed, and therefore I worry about an environment where central banks are all saying the right things. It's interesting, you're only seeing some of the more emerging market banks continue to hike rates aggressively, and that tells you about people that are very fearful of inflation. I think the Fed is moving faster on the taper, not necessarily because they're so excited about growth, but they too are worried about inflation. So I think that's the thing that we have to be careful of. I think the EPS revision dynamic may be the place I'm most worried, but I would just drill into the places where he is reasonably constructive on next year. And he's talking about both multinationals. So think of a Coca-Cola, think of a Raytheon, and he even has Walmart on there as you get into slightly more value-oriented companies that I think are less exposed to some of the cyclicality of interest rates. I think that is the call, and I think those are trades that actually will do well in 22.
Karen, I know obviously you're in some retail names. Any of those seem to make sense to you, potentially add positioning if inflation takes off, is even hotter than expected on Friday or beyond?
Was that to me? I couldn't hear
Yes,
you.
sorry, Karen. Yes.
Oh, okay. Anyway, so what, the retail names that I like,
yeah,
I
just some of the retail questions. I mean, Tim brings up Walmart. That could be a good place to go if consumers tend to be more value-oriented in the face of higher inflation.
Well, Target is actually my biggest retail position, as well as Home Depot and Lowe's. That's a little bit more of a housing plays. But Target's my biggest position. It hasn't been great in the last couple of weeks, although it has had a very, very good year. I actually bought a little Foot Locker today. I've traded around it a couple times. I cannot believe how cheap it is.
Yes,
I know
that's
that,
right.
you know, it's crazy cheap, but, you know, clearly there's some headwinds to the business, but still ridiculously cheap. And then I own Capri. I'd like to see, I mean, that had a nice run recently. It's a Steve Grasso name as well. So that's sort of my retail exposure. And I think that they do have, some of them have good pricing power. Lulu,
Right.
I'm out. They have excellent pricing power, but it's too expensive for me.
Yes, absolutely. And I remember talking about Foot Locker after those earnings results and the name really taking a dive. You had mentioned you thought about nibbling, so sounds like you did go ahead and dive in.